It's week number 4 of Business 630 Corporate Finance. This is Professor Hasse speaking for our week 4 lecture for the week of November 15th to the 21st. Professor Hasse's a little late this week because of midterm grading, and I apologize for that. Our topic this week is the cost of capital and capital budgeting. For some of you, it's an old friend. You've studied this before. For others, it's brand new. So we're going to try to give you a brief overview this week in week 4 of the capital budgeting system and analysis. And then next week in week 5, we continue our discussion into capital budgeting risk analysis. I have a sample file that is in week number 4 of an in-class review that I'd like you to download and work on that file and see if you can do it. I will post the answers to that capital budget file in my Friday video. I think the most important video of this week 4 is the Friday video. I will review case number 1. The grades have yet to be posted. I'm still working on them. It's a lot of work to read 28 papers. And so you got to give me a little time on this. Also on Friday, I will introduce the Electrics Incorporated case, which is due the last week of class. This is a capital budgeting paper. And also I will prelude the case of next week, which is doing a spreadsheet of exactly the things that we're talking about this week, which is due over the Thanksgiving weekend, November 28th, and I apologize for that. This is the halfway mark, if you can believe it, of our course, and it's very fitting in a finance or corporate finance class at the halfway point to talk about probably the most important thing to corporate finance, the ability to do an analysis of an investment in an asset. In that analysis, is the asset going to give us an adequate enough a return based on the cost of capital and the projected revenue and expenses of that project, and then to do a return analysis to analyze that information. And that's what we're doing this week. So let's take a look at that spreadsheet that I would like you to look at this week. Okay, here's our Blackboard site, which I just wanted to let you know. Some of us are visiting this on a regular basis and some of us are not. I assure you, as a word to the wise, if you are not visiting this Blackboard site on a regular basis, beginning this week number 4, you're going to have a very difficult time getting through the material of the next 4 weeks. It's imperative that you hit this site at least 2 or 3 times a week for updates, for videos, for work problems, review problems, to stay up to date with our studies. That being said, let's go to week number 4 for this week. And I have the agenda, which I've already shown you. And here's the most important part of this week week 4 in-class review file folder. Remember, in the Blackboard setting, you want to right-click and save the link to your desktop. Save it to your computer. Do not open files in Blackboard. First of all, it takes up a lot of memory, and usually you don't get the file that you want. The link doesn't work. If you're going to work with files that are in Blackboard, you have to right-click them and save the link to your desktop or your flash drive. So that's important. Also, there's some great definitions about capital budgeting. Here's a very good PowerPoint. Here's some definitions of capital budgeting, cost of capital. Some more PowerPoints from the chapters, but those aren't that important. We're studying this next 2 weeks, chapters 9, 10, and 11. But be honest, and remember, our textbook is optional in this class. I'm providing you all the necessary information you need, all the definitions, all the review problems you need. Here's a video that you might want to review about capital budgeting. But the main thing is this file. It's called Week 4 in-class review. And here is that file. There are 5 tabs to this file, and I'm starting off with the middle tab, which very basically describes the capital budget process. Remember, capital budgeting analysis in finance is determining where you're going, how much return you're going to get from an investment. And it's basically putting together a cash flow analysis, revenue, expenses, taxes, cost, depreciation, net working capital, all kinds of stuff. And many of you have done that prior to this class, but I know some of you, it's been a while and you have not, but this is the process we're going to be doing in case number 2 next week. This is the main process that you're doing in your case review paper and analysis called the electrics case, which will be introduced this Friday's video and do the last week of class. So this is the process. You have to determine the amount you're investing. How long is the depreciable life of that asset, which will indicate how long your analysis will be. What is the revenues and operating expenses being proposed for this project or for this investment? What's the net cash flow, taking into account net income, adding back depreciation, working capital, salvage value? And then you do a return analysis. What is the return of this cash flow? 4 different ways of looking at the same information: net present value in dollars, internal rate of return in percent, profitability index in a ratio, and a payback in the amount of years to pay back the investment. And then what we're going to be talking next week from chapter 11, the risk analysis, scenario and sensitivity analysis. Is the information you're providing in your capital budget, is it reliable? Is it correct? What are the chances and what will it look like if things go different ways? That's what scenario and sensitivity analysis are. Again, you'll be practicing all these things in our class sessions this week and next. Next week, you'll be doing a spreadsheet analysis using these techniques to practice. The first item I'd like to discuss is, in order to do a capital budgeting analysis, you have to determine what is the cost of the money you're getting. It's called the cost of capital. It's called the weighted average cost of capital. And the cost of capital is a combination of 2 things: the debt and the equity it takes to fund your asset base. The cost of capital is basically taking a snapshot at a point in time of your balance sheet, of your capital structure. And we've talked about this before. In your risk analysis of case number 1, I ask you to find the capital structure of a company. How is your company funded? What percent of assets are funded by liabilities? And what percent of the assets are funded by equity? Each of those 2 have costs. The cost of debt is the interest rate you have on that debt, and then taking into account the tax rate of the debt of your company to determine the after-tax cost of debt. And here's the formula for that. If I'm paying 10% on my debt to fund my company, and that usually in real world, that's an average of all the debt you have. Remember that this is interest-bearing debt. Accounts payable, accruals, short-term debt is not included in this analysis because it has no cost. It's short-term, you pay it back. So we're concerned about long-term interest-based debt. And let's say in this example, it's 10%. Let's say our company's tax rate, which is rather high for today, now it's more like 22, 25%. But in this example, we'll say our tax rate is 40%. The after-tax cost of debt is 6%. Why is it 6% and not 10? Because we take into account the tax rate. It's the interest rate or the current yield on your debt times 1 minus the tax rate. So 10% times 1 minus 40% is 60%. So 60% of 10 is 6%. That's my after-tax cost of debt. Okay? Pretty simple. All you need to know is what your interest on your debt position is, and at the same time, what is your tax rate? And in our problems in this course, those numbers will always be given to you. Okay, what is the cost of equity? Well, we studied that in the risk evaluation of case number 1. The cost of equity is the expected return that you expect or the investors expect on your stock relative to the market of risk-free, 0 beta, average return, 1 beta, which is the market return, and the specific company's beta, the risk of your specific company. We've looked at this. So the expected return on the cost of equity is the risk-free rate plus the market premium times the beta of the company. And the market premium defined as the market return minus the risk-free rate. So in the case of this example, the risk-free rate is 1.75. The market return is 8.5. So our market premium is the difference between 8.5 and 1.75, or 6.75%, times 1.5 the risk of the specific company. Do the arithmetic. Your cost of equity is 11.88%. All right. So that's what the investors of equity are expecting to get as a return off this company. And basically that is telling the company that's their cost of equity. If this money does not return at least that amount, your investors are not going to be very pleased. So in the context of this problem, we have an after-tax cost of debt of 6%. We have a cost of equity or expected return of 11.88%. In the context of this particular capital structure of 44 and 56%, if I take 44%, the weighted average of after-tax cost percent, or at 6% is 2.64. If I take the 56%, the weighted average of equity is 56% of 11.88. That's 6.65. I add those two together, and that's my company's cost of capital, 9.29%. So if I was doing an analysis, that is called the cost of capital. It's called the hurdle rate. It's called the opportunity cost. It's called the cost of your cash, your capital, better known as weighted average cost of capital. Why weighted average? It takes the weight of your capital structure and weights it to the actual cost of that segment of the capital structure, and you get 9.29%. In other words, I should be making hopefully quite a bit north of 9.29% off this investment in the assets. If I don't, I'm looking for trouble in raising capital and keeping my investors happy. Okay? That's the definition of cost of capital. So you need to do that first before you even look at the capital budget process. Okay, so now we've gone over the cost of capital. Now we're going to begin the capital budgeting process. First, I want you to practice coming up with the cost of capital. So here's another tab called WACC, and I'd like you to do this on your own this week. I will post the solutions on Friday. You can look at them then, or wait until you do the problem according to your schedule and then go in and get those solutions later on and check your work out. But I want you to find the cost of capital for this company, where the question marks are and where the highlighted numbers are. That's what I want you to find with the formulas based on our learning and discussion in this section. So with a company with a debt to assets of 60%, a tax rate of 30%, an interest rate on their debt of 9, a risk-free rate, market rate of return, and a beta, what is their after-tax cost of debt? What is their cost of equity? What is their capital structure? And what is their WACC? Try to do that. Download this file. Again, remember, download it to your desktop. Do not open the file in Blackboard. Try to do that this week. And then when you come up with that, you'll get a number here. And that number will now go to this capital budget analysis and go right there. And that will be your cost of capital for this problem that we're going to do. All right. I'm going to leave this blank. You're going to fill this in. Now, the good thing about this, I've included a lot of formulas already that do a lot of the totals, so you don't have to worry about that stuff. But again, you can look at the formulas and see how this all works. But I want you to go through this file in the next couple of days and determine, based on these inputs, and your knowledge of the capital budget process, and I will review this in my Friday video, so don't anyone freak out if you look at this and you can't figure it out. But this is what you need to do in case 2, and this is what you need to do in the electrics case. Your bottom line is to find these 4 numbers. Let me put these in this type of highlight. What is, you really need to find this one too, the discounted cash flow, which is taking the cash flow and discounting it over the depreciable life of 10 years at whatever the WACC is, your cost of capital that you find. What is the net present value, which is the difference between the discounted cash flow and the net of the investment? I'm going to do a couple of things on this to get you started. What is the internal rate of return? What is the profitability index? What is the payback in years? Now, again, by being in this class, I assume a lot of you have done this before, but okay, don't worry about it. We'll be reviewing this, but I want you to try it on your own. All right, you can refer to the text if you want, or you can refer to anything else, the videos, whatever, but you're going to construct this. So remember, let's take a look at the variables. The investment is $1 million. So we're investing today in year 0, $1 million. All right. The salvage value in year 10, in other words, this is going to have a depreciable life of 10 years. And in the 10th year, the salvage value is going to be $50,000. Depreciation. So we're going to fully depreciate the asset over 10 years at $100,000 a year. So that'll go there. You're going to sell 25,000 units every year over those 10 years at a unit price in the first year of $20. $20 times 25,000 is your revenue or sales in year 1. But then you're going to inflate that every year after year 1 by the inflation rate of 2.5%, which makes sense. Probably should be a little bit higher according to today's inflation rates. Then your variable costs, and let's type this here, variable costs. The variable cost rate is $8 per unit. This is an expense. So you're going to take $8 times 25,000 units, and there's your variable cost expense in the first year. That is going to be inflated at an inflation rate of 2% every year. Your fixed costs, in other words, costs that are not associated with volume, is $50,000 a year in year 1. That's going to inflate by 1% every year for the remaining 10 years. So an inflation rate in year 2 of sales of 2.5% and subsequent years, an inflation rate of 2% on variable costs, and an inflation rate of 1% on fixed costs. Why all different? Well, this company who is deciding to put this project together has different types of cost estimates, cost growth, sales price growth over time, and that's what they've decided. Once you put all these together, sales, expenses, depreciation, you'll come up with your earnings before taxes. Sales minus expenses. If you look in this cell, it takes sales and minus the 3 expenses, and you'll get your earning before taxes. Your tax rate is 30% in this problem. So 30% of this number will be your tax. Then you subtract that tax from the earnings before taxes, and this formula here will figure out your net income. Then your net income is your net accounting income every year for 10 years. Then what you're going to do is you're going to determine the net cash flow of the project by taking into account the salvage value in year 10. And remember, you're fully depreciating the asset over time. So this $50,000 in year 10 has to be taxed at your tax rate to determine your net salvage value. You're going to add back in depreciation of $100,000 here. Why? Depreciation is a non-cash expense. So to get a true number of your cash flow, you add back in depreciation because you're not spending any money. You're not writing a check to Mr. or Mrs. Depreciation. And then the last big deal is working capital. Working capital is that cash flow over and above the investment in the asset that's going to maintain the asset over the life, and you need to be reimbursed for that over the course of the project. Working capital is a percent of sales, 12% of sales. So when you determine year one sales revenue, you're going to take 12% of that, and it's going to be a negative cash flow in year zero today. And then over time, you're going to maintain that 12% of sales in the following year as additional working capital needs. Remember, you're going to maintain 12% of sales the following year. So you already had 12% here. Whatever your delta is between year two and year one revenue will be your working capital at 12% for the subsequent years. And then in the 10th year, you're going to add back in all that working capital expenditure because the project is now over. You've been reimbursed all that capital over the life of the project, and this will be a positive cash flow, which will basically be 12% of year 10 sales adding back in to the analysis. The net effect of working capital over its life of 10 years, including year 10 add back, should be zero. Zero. This should be totaling zero. Negative cash, and so on until positive cash, 12% in this case of year 10. All this will total zero. But you're showing in your analysis the need for cash at different times during the life. So your net project cash flow is net income plus depreciation minus working capital equals cash flow. And there's the formula there. So you just have to come up with these numbers and the formula will do its work. And then you also have to determine the after-tax salvage value cash flow in year 10. Once you do that, then you can determine the discounted cash flow by taking all the year's cash flow and discounting it back at your cost of capital that you determined here. The difference between that discounted cash flow and your investment, which will be a little bit more than $1 million because you're going to have a number there that you're going to calculate, will be your NPV. Your internal rate of return is using the IRR function. Profitability index is a ratio, and so on. So let me just wipe that out here because that'll confuse you. There you go. So let's see if you can remember the capital budgeting process. Probably you won't. So start the problem, take a look at it, or wait till Friday when I walk through this entire process and fill in these numbers. And then maybe you can use that as an example or as a test, and you can go back and open up this file with the blank columns and see if you can try to do it. But I encourage you in the next couple of days, if you can, try to finish this out on yourself. See if you remember or have information or have knowledge of how to do this. But again, on Friday, we will walk through this work. So don't anybody get all panicky about it. So once we complete this analysis, we will have, is this project going to produce an adequate return to cover our cost of capital and make profits in dollars, in percent, in a ratio, and in time. That's our job this week's class. Next week, we'll take a look at the final tab in this spreadsheet, which is risk analysis. Here it is right here. We'll take a look at scenario analysis and sensitivity analysis, which are from chapter 11. Don't anyone panic. We'll walk through this next Monday and Tuesday in our lecture video for week number 5. But if you already know how to do it, go at it, people, and see if you can put this together. But again, don't worry about it. If you can't get it, I'm walking through it on Friday. So again, the capital budget analysis of the topic of week 4 is chapters 9 and 10 to determine the investment in an asset today, in this case, $1 million, and the estimates of sales and expenses and costs into the future, and determining, comparing those costs and profits and cash flow to the investment we're making today in looking at it in dollars, percent, ratio, and return in years. And is this a feasible project to do? Every company in the world, when they invest in assets, does this. Trust me. Even not-for-profit companies do this. So this is a key part of corporate finance strategic thinking. And what we're going to be doing next week is, okay, now that we understand this, how do we strategically use this information to make decision making in regards to capital budgeting? And we'll talk more specifics about that strategy next week. This week, we're talking about how it all puts together. And remember those days of our earlier finance courses of how this capital budget stuff works. If any of you want to look back on referencing that, if any of you have had business finance in your graduate program or your undergraduate program, look for the capital budget analysis. And if you're a Laverne student, look for the Road Kings case, the California Best Trucks case. Those are cases that have been used in other classes. Maybe you have done them. Go back and refer to those. If not, don't worry about it. We're going to walk through this on Friday. But that's what we're doing this week. So download this file, try to do it, or at least study it, learn the definition of cost of capital, learn the process of capital budgeting. I think probably you all could do this, determine the WACC. That shouldn't be too difficult. And then we'll talk about these this week and next on how to put this all together. That's our topics for this week. Okay, that's where we stand for this week. Again, this file that we just saw in this video is located right here in week number 4. You right click it, save it to your desktop, and get at her. This week and next week are our number crunching weeks. This is our spreadsheet weeks. This is when we crunch numbers. The subsequent time in going into the head in the future, then we'll look at what the numbers tell us and how to be strategically thinking about what the numbers tell us. But before we can determine that, let's make sure all of us know where the numbers are. Now, again, I strongly urge all of you not to blow this off and not to shy away from this. Get to this as soon as possible. So when Friday and this weekend comes, you can look over the material, kind of figure out what you know and don't know, and review it. Because if you don't study this, you're going to have a very difficult time next week with case number 2. And then you're going to have a very difficult time with the electrics case, the case that you're doing for the end of our course, our assessment case, it's called. So make sure you look this over, understand it. I will be reviewing all this in my Friday video. So as I said earlier, Friday video is the most important video of this week. Now, the solutions for the case study number 1 will be posted to this file folder, case study number 1, as soon as I get that information finished. I'm still working on it. I'm about 2/3 finished with all your grading. Hopefully in the next day or so, I'll get that to you. I'll review case number 1, how I graded it, the rubric, the assessment in my Friday video as well. So if you want to start working on this spreadsheet in week number 4, tomorrow night, Thursday, in my student hours, we can walk through that. We can look that over with some of you who call in. That might give you a head start to the Friday video by walking through that, and maybe you can show me your work next week if you come tomorrow night, Thursday, in our student hours. I know a lot of you cannot make Thursday student hours because you have other classes or work commitments. But again, this is the time 4 weeks into our course that we need to start really getting engaged if we want to do well in this MBA 630 class. All right, everybody, I appreciate your engagement. We're halfway through. Now we're starting into the real meat and potatoes, not to sound corny about this, but now we're starting into our meat and potatoes of this class. And so I look forward to seeing you all, if maybe some of you on our Thursday student videos or student hours. And then I'll see you on our Friday review videos of case number 1, the electrics case, and this case or this sample review problem that I've posted today. Thanks, everybody. We'll talk to you soon. Adios.